When starting a business, one of the biggest challenges is securing funding. Today, we're exploring two major sources of early-stage capital: angel investors and venture capital. Understanding the differences between these funding sources is crucial because each comes with distinct advantages and trade-offs. By the end of this video, you'll know which funding path might be right for your startup and what you'll need to give up in exchange for that capital. Angel investors are high net worth individuals who invest their own personal money into early-stage startups. These are typically successful entrepreneurs or executives who want to help the next generation of founders. Angel investors usually write checks ranging from $25,000 to $500,000 per investment round. They're called angels because they often step in when a startup is too early or too risky for traditional investors, providing that crucial first boost of capital when you need it most. Working with angel investors offers several key advantages. First, they make quick decisions with minimal bureaucracy, often approving investments in weeks rather than months. Second, many angels provide valuable mentorship and open doors to their industry connections, which can be just as valuable as the money itself. Third, they offer flexible terms and are generally more willing to structure founder-friendly agreements. Finally, angels focus on early-stage ventures, meaning they're comfortable investing when you only have an idea or a basic prototype, not just a proven product. Of course, angel investment comes with trade-offs. You'll typically give up 10 to 20% equity ownership in your company in exchange for their capital. Angels may also request a board seat or advisory role, giving them influence over important company decisions. Because individual angels have limited capital, you'll likely need multiple funding rounds as you grow, which means repeatedly raising money and diluting your ownership. Finally, angel deals often include risk protection terms like liquidation preferences or anti-dilution clauses that favor the investor if things don't go as planned. Venture capital firms are professional investment companies that manage large pools of money from institutional investors like pension funds, endowments, and wealthy individuals. Unlike angels who invest their own money, venture capitalists are investing other people's money and have fiduciary responsibilities to deliver returns. Venture capital investments are significantly larger, typically ranging from $1 million to over $50 million per funding round. This makes them ideal for startups that need substantial capital to scale rapidly. Venture capital brings powerful advantages to growing startups. Most importantly, you gain access to large amounts of capital that enable aggressive growth and market expansion. Venture capital firms have extensive networks and can introduce you to potential customers, strategic partners, and future investors. They bring professional expertise in scaling businesses, having guided many companies through similar growth challenges. Additionally, having a reputable venture capital firm backing your company provides instant credibility, making it easier to recruit top talent, win customers, and attract follow-on funding. Venture capital funding requires significant sacrifices. You'll give up 20 to 40% of your company per funding round, and most startups raise multiple rounds, meaning founders often end up owning less than half their company. Venture capitalists typically demand board seats and substantial decision-making power over major company decisions. They'll push for aggressive growth targets to deliver returns to their own investors, which can create intense pressure. Finally, venture capitalists expect an exit through acquisition or initial public offering within 5 to 7 years, which may not align with your vision for building a long-term sustainable business. Let's recap the key differences. Angel investors are best suited for the idea to prototype stage when you're just getting started, while venture capital is better once you have a proven product with market traction. The angel investment process typically takes weeks to months, whereas venture capital fundraising averages 3 to 6 months. In terms of control, angel investors generally allow more founder autonomy, while venture capital involves shared decision-making and closer oversight. Choose the funding source that aligns with your current stage, capital needs, and how much control you're willing to share.
If you like this video, Hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.